So we will continue with our assessment on the Nifty 50 on the hourly time frame. We will note that since the formation of the death cross, every time the market has come towards its previous moving averages, it has got rejected and the market has gone on to form a new low. With today's close, the market is exactly at one of those critical moving averages. And here now is the question that all traders will be asking: will the market continue its downward trend on the hourly chart, or will the market break this and change its trend type from downward to range? Once again, when the market will end this bear trend on the hourly chart, the trend will shift from bearish to range, unless of course there is the odd chance of a V-shaped recovery. But by and large, we will note that trend changes usually happen in these fashions. So now, what would be the plan for tomorrow? Based on this, we can see market closing is pretty much at the last level of responding for a sell side trader, which would mean that 1 ATR above this level would be the exit point for any sell position that would be created, and all sell positions would have either been created today or perhaps tomorrow, unless there is a gap up open. What do I mean by that? Given that the bias preceding today's price action was on the downside on the hourly chart, the traders would have had a sell plan for the day today. And like all sell plans, the plan for selling has to be to sell the rise. If you remember yesterday, we discussed that the 20 period moving average was around 22,120 and the 50 period moving average was 22,420, automatically making it potential sell zones, and 22,500 would be the stop loss, which is 1 ATR above the 50 period moving average. And in that video, single time frame versus multi time frame trading, I mentioned that single time frame traders would be mechanically entering the values at which they want to enter, whereas multi time frame traders would be looking at confirmation within the intraday charts itself, that is the 15-minute and the 5-minute charts, to take up a sell position. So assuming there is a trader who is an aggressive trader and wishes to trade strong trends, then such a trader would have sold straight out of the open. Whereas if the trader was a conservative trader and would have sold on the test of the slower moving average, that's the 50 period moving average, they would have sold far later in the day. Whereas the multi time frame trader would have moved on to the 5-minute charts, and obviously we know that the market became oversold right in the open. That is, if we go to the 15-minute chart and if I set up an oscillator RSI and keep the setting as 4, because I'm dropping the time frame from 60 minutes to 15 minutes, you will note that at the end of the first candle itself, the RSI had become highly overbought, which means that from the first candle itself, the trader would look at a lower top, lower bottom formation on the 5-minute chart in order to take an entry. So here we will see that the market opens clean up, and if we have, this is the first higher top that the market forms. Right here during the day, which was formed pretty early in the day in the first half an hour of trading. Subsequently, the market creates a low, and this is a higher bottom. Now logically, this higher bottom, once the market retested this top, the expectation would have been that if it goes on to create a new low, the trader would have initiated a sell, but that didn't happen, and the market continued with creating another higher top. Right up till here. And in all of this higher top, the previous higher bottom is marked here. Now, obviously, so far the trading has not yet shifted, but at the second part of the day, we will see that the market has indeed created a higher bottom somewhere around these levels. And a break from these levels would have initiated a sell at about this candlestick. So I'll just darken this. So first of all, how do I determine higher top and higher bottom in a practical setting. So I have what is known as the rule of 6. This is my own rule basically, and of course it is derived out of studying various books and chart patterns. And the rule is very simple: if a high or a low holds for 6 candles, then I will assume a pivotal high or top. So here we will note that the candle here, this particular low that is formed on this candle, has comfortably held on for 6 candles and beyond. And since that has happened, this candle would form the higher bottom for me. Or one could argue that this candle would form the higher bottom if you count 1, 2, 3, 4, 5 and 6. But pretty much around this candle, the sell would have initiated for the day, because this would be the first breach of the higher bottom. Of course, now the SL was decided well in advance that the SL would be 22,500, and that would be the trade for the day. You will note that the trade actually happened only at 1 o'clock in the afternoon, giving the trader very little time in the day to do anything significant. And pretty much the market has closed at nearly the same level. So where a single time frame trader who would have shorted at the 20 and the 50 period moving averages, that is at 22,120 and 22,420, which were the values yesterday, that trader would have got an average sell of 22,370, and the market closed at 22,350, breaking even. Whereas a trader who used a rather precise form of entry would have also got an entry of around 22,350, marginally profiting on paper. But when you come to realize it, you will note that both the traders actually broke even. In other words, today, with a clear plan and perfect price action trading, one could assume that the sell side traders were of course not rewarded. So all the test that is there for the market in terms of the hourly chart trading will be decided tomorrow and by day after. It is my view that if the market, we can see that the 50 period moving average is 22,350 approximately, and I will just set up the ATR on the hourly, which you will note is roughly 75 points. In other words, 22,425, which I will mark in dark green, would be the final SL for any short position. If the market takes this high out in the open itself, then no trader can initiate a sell position for the day. In fact, there will be no day trade at all, because then the market would have started the day with a sell bias, but would have gone on to taken out the previous resistance, which is not consistent with the sell bias. So if the market opens up, there is absolutely no trade at all. The market becomes very interesting if it opens lower. If it opens lower, that is when the trader will have to plan their trades with an exit of 22,425. And if the trader has mechanically entered at these moving averages, then such a trader will again mechanically enter at the 50 moving average tomorrow if it opens lower. That is the rise up to the 50 moving average. While if the trader has used multi-time frame trading in order to determine when to enter, they will continue to use the same process as outlined yesterday. That is, the trend is a sell on rise on the hourly, wait for 15-minute charts to get highly overbought, and then look for some lower top, lower bottom formations on the 5-minute charts in order to confirm your entry. But regardless, the SL is 22,425. And if we set the indicator ADX, we will note that the value is well above 25, once again encouraging the trader to buy a put option for the day tomorrow. So with this bias or with this assessment, we will close the video today. But I would just like to add that at this point in time, you should also note what the swing traders are seeing. You see, we are doing this exercise on the hourly charts simply because we want to use as much price action that unfolds in front of us for practice. And hourly charts give us a good deal of practice. Here you will note that on the daily charts, the market is also on a sell. That is, we are seeing a bearish crossover. We will note that the previous test of the market before creating a new low was at the 50 period moving average. In other words, the previous test indicated that the market is bearish weak. At this point in time, of course, we are seeing a couple of clean bullish belt hold candles, which is highlighting a recovery. And the reaction recovery, typically, even for a bearish week market, is usually the 50 period moving average again, which would be around 23,000. But even if not, then also it averages to about 20 period moving average, which would be around 22,800 or 750, as this will dip lower as each day progresses. So this has to be kept in mind. So therefore, the day trader who is selling tomorrow, who has to sell tomorrow because the trend is downwards, and will be using his technique of price action to determine the intraday selling, that day trader must necessarily square off at 22,425 as this system warrants it. Because in the odd chance you do not square off that position, there is a real risk that the market will change its trend from the hourly and shift towards daily price action. And we can see that the nearest resistances are still 300 points away on the daily charts, which is close to this particular gap right here. That will be very crushing for any short position if that is to happen by Thursday or Friday. So one of the advantages of markets being very close to the previous price is that it offers a potential great entry, but it also offers the potential of breaking away from that region, which the trader has to be mentally prepared to see, and because of the extremely oversold conditions of the market, and must exit the trade. If you are unwilling to take the loss, of course you should not take the trade. With that, I hope that this assessment today will help you in your planning for the subsequent trade sessions.